What is going on? Welcome to my channel. I am the covered call guy, and my goal is to create $120,000 passive income portfolio using only covered call ETFs. Right now, my portfolio yields about $72,000 a year, $6,000 a month, $1,400 a week, and about $200 per day. I will be updating this at the end of every month. So for December, in about a week and a half, hopefully I would have crossed $75,000. That is the goal for ending 2025. Of course, I am praying these premiums stay juicy and consistent, but we'll never know, right? With the way the market is, we don't know. Legal disclaimer before we start this content. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete. Investing and trading involves significant risk, including the possible loss of principal. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just a random idiot you found on YouTube and I could be completely wrong. Now let's get started with today's video. I feel like this would be a great topic, especially for those that I'm starting to see in the comments, and I'm starting to see my channel grow, starting to see a lot more diversified kind of people who do only invest in certain assets. Of course, I'm not saying there's anything wrong with it, but it gave me an idea, right? So it gave me the idea of the debasement trio, where for those who are investing, obviously you are educating yourself in the financial space, right? So um, fiat currency will always get debased and get devalued. So this gave me an idea of, hey, these are the three ETFs that you can possibly just, if you are that type of person to have that type of risk, and or you can have these three ETF make up your portfolio. So it is the debasement trio I'm going to be talking about. Annual income ladder, just harvesting volatility in a broken monetary system, right? Turning monetary decay into cash flow. All right, the thesis for this video: infinite printing thesis, right? Turning monetary decay into cash flow, right? So for those, obviously you and I, we know that the financial system is no longer governed by growth cycle, right? It's governed by fiscal dominance. Sovereign debt has reached a point where monetary policy exists primarily to service liabilities, not to preserve your purchasing power. As you guys know, the dollar has lost what, 50% of its value again over the last 7 years. So just think about that. Right, so your global money supply has expanded exponentially over $100 trillion by 2025. In this regime, your traditional portfolio collapses, right? Bonds fail you, real yields disappear, and capital preservation becomes an illusion. How do we fix that? Right? One, the new regime, when your old playbook stops working, right? From 60-40 to 0-0. Your classic 60 portfolio assumes three things: bonds provided you a positive real yield, equities compensate you for inflation, and central banks can stabilize cycles for you. All three are broken, in my opinion. Under fiscal dominance, sovereign bonds no longer hedge your risk, they transmit it. With negative real rates, your risk-free rates become return free risk, right? So it kind of just swapped and became opposite. It's no longer safe. Then we talk about the hard asset trifecta. These are the three that I'm going to be talking about. Gold, silver, and Bitcoin occupy a shared position for you. They are non-sovereign assets with constrained supply. But more importantly, they are the assets the market fears mispricing, right? Gold, your primary central bank reserve asset, right? I hit about like 4,300 an ounce in 2025, give or take. I'm guesstimating here, rounding it off. Silver, facing a dual shock of monetary demand and industrial consumption, right? Solar and EVs. And then Bitcoin is the digital gold for us millennials and Gen Z, with rising correlation to gold as institution adopts it. So I'm starting to see some comments where there are the older folks, and when I say older, I'm gonna say about 50 plus. They really love these gold ETFs, and so it gave me an idea. You know what? For those who are willing to risk it, that have that high risk tolerance, you can essentially just own a gold ETF and a silver ETF and BTCI. So what is like, of course, I was gonna say what is stopping you, but obviously, that risk correlated to it. Or you can have these three mixed into your portfolio and it becomes a core. And this becomes the hard asset trifecta. That's how I'm kind of nicknaming it. What? Number point two, why volatility is your new yield? The insurance business model, right? Volatility harvesting is simple in concept and brutal in execution. What I mean is, you sell insurance to anxious investors, right? Using IV, implied volatility, persistently exceeds realized volatility, right? RV, right? The gap is RVP, variance risk premium, exists because investors like you consistently overpay for protection and convex upside. What that means is gold options price crash risk that gives you the downside skew. Silver miners price operational for fragility, and Bitcoin options price both collapse and moonshot scenarios. So you kind of play all sides to it, right? You kind of like you can cushion yourself for the blow, then for the flat market, and for the surge for the bull markets. All right, the first one we're going to talk about is KGLD, your monetary anchor that pays you, right? The row is synthetic reserve asset. The yield is about 12.2%. I'm taking it from annualized distribution rate as of late 2025. The mechanism behind this ETF, well, KGLD replaces sovereign bonds for you. It creates a synthetic long position on gold ETPs to replicate price movement while holding short-term US T-bills to earn interest, and then writes call options to generate high monthly income for you. The risk profile for this, capped upside during gold melt up, right? Full participation and downside. It is not safe. It is stable relative to chaos. So let's understand that difference. Number two, SLJY, weaponizing silver's instability, right? The mechanism behind this ETF, silver miners are structurally unstable. That instability is your opportunity, right? SLJY writes cover calls on junior silver miners, SILJ, extracting premiums from operational leverage and speculative flows. The trade-off, exceptional income versus chronic NAV decay risk, right? This is not a buy and forget holding for you. It is a premium extraction tool that demands active income management. So this is for more of the active traders. The row would be volatility amplifier, right? With the yield of 22.4%, as I'm taking it from the annualized distribution rate of late 2025. All right, let me talk about BTCI, turning cryptomania into your paycheck. The row would be convexity monetization. The yield is about 26.7%, taking it from annualized distribution rate of late 2025. The mechanism for this is Bitcoin's defining feature is volatility. BTCI exploits this for you by gaining exposure to Bitcoin futures ETFs and writing calls. Crucially, it uses tax-efficient structures to defer your tax liabilities, not defer, delay, but not, take away. All right, so understand that difference. The key risk with this, however, future road drags and severe underperformance during parabolic rallies, right? BTCI does not chase Bitcoin, it taxes it for you. So let's understand the difference from them. All right, volatility as an asset class. We have gold, KGLD, sells fair, hedging against currency collapse. Silver, SLJY, sells instability, industrial squeezes and mining risk. And Bitcoin, BTCI, we sell the hope, right? FOMO and lottery ticket upside. The latter works because these emotions rarely disappear simultaneously for you, right? You're always going to have one of the three, two of the three, or three of the three. So, each component monetizes a different emotional premium for you. Income as leverage, your core innovation, right? So we're just going to take a scenario here, right? So your income reality check, we're using, if you were to own all three, we're going to aim for a combined yield of about 21%. And we're just going to do scenarios here, right? At 21% annual combined yield, capital deployed, 10,000, you get 2,100. 30,000, you get 6,300. 75,000, you get 1,500. 100,000, you get 2,100. 21,000. $200,000 deployed, 42. Right? That's basically a job right there. At 350 deployed, you have 73. That's an actual salary. You're mid tier, right? Managerial level. At 500,000, you're at six figures, right? I would say this is the freedom number. And at 1 million, you got over 200,000, right? This is pretty much now you're preserving wealth. Of course, that's if you own only just these three, right? This is scenario based. This is for the people who have the high risk tolerance and really believe in like currency debasement, and saying, you know what, I'm just gonna own these three assets. Of course, these are the very few people, but it's just giving ideas, right? This is just something to think about for fun, and or you own all three to kind of mix in with your portfolio, right? We're going to be redefining leverage, right? Traditional leverage borrows capital. This strategy recycles cash flow. At a 21% gross yield, your capital paybacks occur in under 5 years. Assuming, of course, right, this collapse portfolio duration and front loads inflation risk for you. Income become optional leverage rather than your survival income. Now, of course, we gotta do the stress test, right? On this channel, we always try to do stress tests. And I'm gonna talk about the pros, and I always talk about the cons. Where you thrive and fail. The first principle, let's talk about the hard truths. Income is not guaranteed. Distribution or volatility harvesting, not coupons. NAV drawdowns, right? If you can't tolerate a negative 30 to negative 50%, this strategy fails you psychologically. The enemy is not drawdowns, but you selling at the wrong time, right? You're supposed to sell the emotions, but instead you got played by your own emotions. Right? Stress test. Your drawdown scenarios here. Let's look at scenario A. Mild risk off, right? We go down 10-15% on the underlying conditions. Volatility rises modestly. The outcome, NAV dips anywhere from -5 to -12, right? But income remains stable. My verdict, this is where you earn the yield. Scenario B, violent but non-systematic shock, right? It goes down 25 to 35%. The conditions here, volatility spike. Outcome, income temporarily elevated, then normalized. The critical rule I would say here is do not reinvest automatically. Use income to rebuild cash buffers. And then we have scenario C, systematic liquidity event, right? This is the kill zone. Conditions here is correlation, right? One is the outcome, NAV drops 40 to 60%, income interrupted. My verdict here, you survive only if you have 12 to 24 months of external liquidity, right? You have to have some type of buffer backup, which is why I talk about a lot on my channel. And this is, of course, playing a scenario if you just own all three. Typically, you wouldn't do this unless you actually know the huge risk that comes with it. But for this video, we're just playing around and saying you own all three. Right? Counterfactual analysis, right? What breaks your ladder? Volatility suppression. If the market enters a multi-year low volatility grind, premium collapse, and your income engine starves. Correlation convergence. If gold, silver, and Bitcoin trade in lockstep during a crash, your diversification benefits evaporates, right? All three gonna go down together, and it's just what's happening? Behavioral failure. Dependency creep, right? If your lifestyle scales to consume 100% of the yield, you have no buffer. We talk about this a lot on this channel. You should never be using 100% of your distribution. Okay, first off, you should be treating every payout like a paycheck. Put 10 to 15% aside. You should have a buffer. I would go as high as 50% more. So if your goal is $10,000 a month, you should be aiming for $15,000 a month, right? But only spending like at max 70% of it, and reinvesting the rest and putting more others into dry powder, emergency, all that other stuff, taxes. All right. Point 7, building the ladder without blowing yourself up. Volatility weighted allocation. This is if you do end up owning all three. Hey, I might actually get someone who actually does all three. That would be actually crazy. I don't think I will have, but if this is you, leave me a comment. That'll be insane. All right, so rather than equal weight, risk adjusted sizing dominates for your allocation key. I would go 50% into gold just because gold is more, I would, in my opinion, the more stable, the more core, right? I would hold gold as my biggest. If I own all three, gold would be the biggest, right? KGLD. This would be my income anchor with the lowest volatility. Then I have 25% into silver, 25% into Bitcoin, right? Silver is my industrial volatility kicker, and Bitcoin is my convexity engine, right? So cash flow sequencing, harvest income from BTCI and SLJY, anchor it into KGLD, right? And compound it to prevent concentration creep. All right, your hidden alpha, right? Taxes. We always got to talk about taxes, right? ROC, the return on capital mechanism employed by funds like BTCI, is critical for you. Tax deferral. Distribution classified as ROC are not immediately taxable. They reduce your cost basis, right? You have to pay that later down the line. Compound effect. This allows your 21% yield to compound with minimal tax friction until you sell. After tax, this latter materially outperforms traditional income strategies for you. My verdict here, if you own all three, which would be crazy, let me know if you do. That would be insane. All right, monetizing monetary failure, right? The debasement thesis, the debasement trio is not an investment, it is an adaptation for you. The core claim of this is income can replace time only if volatility is monetizable and only if you treat income as optional leverage, not survival fuel. This is a controlled income engine. Use it with discipline. It converts global uncertainty into financial optionality for you, right? Use carelessly and it becomes a yield trap, right? Because 21% combined yield is still fairly high, right? The difference is not the market, it is you, the operator, right? Depending on how you treat your portfolio, and if you're the guy that spends 100%, it will come back to bite you. So thanks for watching. If you do own all three, or if you're crazy enough to think about it, hey, leave a subscribe, comment, like, and let me know. I'd love to actually hear back from somebody that actually just owns all three. Or if you own all three but you mix it with in your portfolio, let me know too. Hey, did this video like open? Did you have the same idea about the debasement? Because it's true. When you print money like this, gold and silver, Bitcoin only goes up. So thanks for watching, guys. I hope this was a fun, educational, and informative video. I think I would try to do more videos like this. It's just a little bit more fun instead of doing the generic deep dives. I know I will keep those up too, as long as there's comments asking for it. I'll go ahead and do deep dives. But thanks for watching, guys. Stay tuned. Catch you guys on the next.